Hello traders, the title of the video is how to avoid 78.6% Fibonacci retracement trading mistakes like pro. So you may say to me, George, I already know about that. This is not for me. Or you may say to me, George, I give up on 78.6% retracement years ago. Or you may come up with another excuse, blah, blah, blah. All right. I will encourage you to stay with us and watch the full length of this tutorial so you do not miss anything. All right. So talking about how to avoid 78.6% Fibonacci retracement trading mistake, one of the common mistakes is that people learn about Fibonacci for the first time. I was like that myself, and they tell us that when a financial instrument was trending from point A to point B, see here, it was trending, and they say to us that if it come all the way to the 78.6% level, that's a buy. They didn't give us any warning, they just say that's a buy. A professional hedge fund always buy them. And then they show us all the examples of stocks that did find support at 78% level. And we believe that, and we go around on the hourly time frame, 10-minute time frame, 5-minute time frame, try to buy successfully at a 78.6% level. And sometimes it works, sometimes it does not work. The reason why we are hitting and missing is because we do not grasp exactly what is happening. It is true that if a financial instrument was very, very bullish, okay, and for one reason or another it reaches a pullback to the 78% level, that's 78% discount for the price of this financial instrument. It will be a reasonable, okay, discount if the company is doing well, all right? So suppose we are talking about iPhone 10 Max that came out, that's going to come out soon. So suppose somebody give you, okay, a real good quality, all right, iPhone 10 Max costing more than $1,000, okay. And now instead of selling it to you, all right, at $1,000, the person decided to sell it to you at $220. That's 78% discount. Provided that the quality is good, which means the company is doing well, the future looks bright, all right, but investors that were buying a stock for a year decided to grab, to take some profit, some of them retiring, some of them putting money away, and so on and so on, and they decided to cash out. And the price now is at the 78% level. That will be, okay, a viable buy, okay? That's what usually happens there. So, in order to avoid that mistake, if the financial instrument reaches the 78.6% level after a bullish trend, we must now check the fundamental. Now, for trader, technical trading, I have something here I want to show you in case you say, oh, George, you know that you're not sharing anything. I have something I want to show you here about the chart and exactly what's happening with this stock. The financial instrument that we are looking at is Apache, okay, Incorporated. American stock, Epic, Alpha, Papa, Alpha, APA. So stay with us, belonging to the energy sector, oil and gas. So crude oil was going up, okay, a bit recently. This stock and the S&P 500 was bullish since 2009. But look at this stock, it was in a corrective phase all this time when everybody else was going up. So we need to find out by going to Google Finance, dig into it, check the balance sheet, check the cash flow, perform Google Asset tests, do all the due diligence that we need to do, check the management, see the future, which sector, oil and gas, well, okay, and take everything into consideration and see what the future is holding to this. After that, okay, we will now become technical traders. So there's something interesting happening here. You can see that the price after this high level that he achieved in 2008, around $140. Today the price is at $45. It even went to $34, which is 78% discount. Now, if everything looks good for this company, management solid, fundamental solid, as I mentioned before, it will be reasonable for, okay, smart investor to keep buying this stock at this point, buy and hold. Buy and hold for long term, not for short term. long term, 5 years, 10 years, all right, and see what will happen. But before you start grabbing your wallet and making a decision to buy and hold, I need to remind you that the video is for educational purposes only. It's neither a solicitation or an offer to buy or sell. So one of the mistakes that people made also, apart from just buying because of what they have been told, which I mentioned earlier, another mistake that people are buying is that they buy at the wrong time. So if you want to sow a seed, you want to sow it at the right season. All right? Unless you create a special environment where you can grow your tomato at the wrong season. All right? But in a financial market, it's difficult to create your own symbiosis environment where you can just grow your tomato, so to speak, or buy and hold. So looking at the S&P 500, this is what we are saying. We are trading first the S&P 500. So the S&P 500, or like other major stock indices, they are now in a third area wave. So we are expecting the fourth wave followed by the fifth wave before a correction will take place. That's the general picture looking at the chart at this point in time. That may change, but today that's all we can say, okay? So the second mistake is to buy at the wrong time, which means financial market is bearish and the price is at a 78.6% level. That will be a wrong time to buy. Or fundamental for the financial instrument is degrading. All right, they are losing market share. That is looking brighter for them. And the price 78.6%. Yes, it's discounted, but is it value for money? If it is value for money, but still discounted, then you want to buy, but you want to make sure you buy at the right season. But there are different type of investors out there. Some investors don't worry too much about the season because their strategy is all about long term, thinking of 10 to even 15 years time. So they say the future looks good for this stock. It's now 78.6%. We keep buying it until even if it comes to the 100% retracement, even coming all the way here. So they start buying, you going down, they keep buying, and they say we will leave it there and see what will happen. Those are deep pocket investors. But for somebody who is careful, you want to check the time when you want to enter. For a technical trader, this is one scenario that is very interesting here, which I want to share with you. See, the price came down, you see here, from what? This small double bottom chart pattern. That's the first double bottom chart pattern that the price exhibited at 78.6%. I don't use 78.6%, I use 78.0 exactly. So you may see 78.0, you may wonder what is 78.6 because I only use 70. That's the first double bottom chart pattern. Look what the price did after that. This is for technical traders. All right, so it went up 1, 2, 3, hit the moving at 50. All right, and then look what it did again. It came down again, 1, 2, 3. So again, we have a triple bottom. But if you take into consideration this one here, and this one here, this low, and this one, we may say we have a smaller double bottom chart pattern, followed by a wider range double bottom chart pattern, and the second part of that double bottom chart pattern is a move 1, 2, 3. This double bottom chart pattern at a 78.6% level is a high probability double bottom chart pattern because of this structure here, 1, 2, 3 down here. Not only that, because of the smaller double bottom chart pattern followed by a wider double bottom chart pattern. Another thing that I will mention to those who are technical traders is this one here, 1, 2, 3 retesting, all right, this low. Okay, so we have a lot of 1, 2, 3, retest this low, 1, 2, 3 up, 1, 2, 3 again coming down here. This is a typical high probability double bottom chart pattern. This stock, as I'm speaking to you, a lot of technical traders will be salivating, so to speak, will be itching to buy it. But they hold up, so to speak. The only thing that can be disturbing those technical traders is the S&P 500. So they'll be thinking, oh, the fourth wave will come, then we'll have the fifth wave. If the fifth wave is extended, well, this one may benefit from it and may go up a little bit more before it will pull back again. But as things stand now, it looks very, very bullish. Technically speaking, repeat, technically speaking. So for a technical trader itching to buy this, it will be a mistake to just buy because of technical reason. It is reasonable and prudent in this junction to do a fundamental analysis, meaning that check the management, check the economy news relating to this, check the peers. So if you go to Google for now, it will show you the peers of this company, P-W-E-R-S, the peers of this company, the news relating to this sector, oil and gas, all right? And check the balance sheet, perform Google Asset tests, all right, by comparing the short-term trend, the short-term liability to the current asset. Do they have enough money to survive the short term? Good. All right, now check the long-term view, check the management, why the market was trending and they are going down. Okay? You want to check why. All right, why? And find out more. Okay, on Google Finance, on Yahoo Finance, dig into this company to find out more. But this is a beautiful high probability technical trading setup at a 78.6% level. But one does not want to jump on it and buy anyhow. All we will say to traders is apply to bullish signal above that 78.6% level and implement a top-down trading method. This stock will be out of the woods, so to speak, if it breaks above the nut. What am I calling nut? This is the nut. This point at $65.32, all right? Breaks above the nut and find support. That will be okay. If it finds support and continue to display a high low, so any higher low above 65.32 will be an invitation to buy. But if one is buying here now because of what I've already mentioned, because of the structure here, one must use a different time frame trading method and be very, very gentle. So a little trick that I can share with you for those who are asking me questions about Pitchfork 2, you see the double bottom like this, all right? So I talk about the flat correction, how you can apply Pitchfork 2 to it. Here it is, you can apply also Pitchfork 2 to a double bottom like this. So you see, this is the double bottom, all right? And now, all right, you apply the Pitchfork 2 like this, 1, 2, 3 equal point. For double bottom, you can do that. So this Pitchfork tool will determine the possible path that the price will take. So as I mentioned to traders at the Day Pro traders, you draw a Pitchfork tool. You can also divide each half into two. So you have it. You divide it. You can do that, and with those points, you can pinpoint the hot spot trading zone. The hot spot trading zone are the intersections between normal horizontal key level and any part of the Pitchfork tool. Hot spot trading zone, hot spot trading intersection point. All right. So you can just map it ready. Okay. Doesn't mean that definitely there will be a trading setup there, but sometimes you'll be surprised exactly at the hot spot trading zone. You may see all this line that I'm drawing to highlight the hot spot trading zone. And then you take it one step at a time using a top-down trading method. Like now that you are watching this video, it is prudent to wait for this candlestick bar on a monthly chart. This is the month of September 2018. Wait for that candlestick bar to close. End of November, as a swing trader, you will come back and deal with it. If you want to day trade it as it is now, you can go, for instance, because weekly candlestick bar is closed, and then after that, you take it from there, or at least a daily candlestick bar is closed. So come Monday or Tuesday, you draw a line at the closing price of last week, and then as a day trader, that line, if I put a line there now, I'll color it now into pink, and then you know that that's the closing price of last week. Or you may draw a line at a high and low and a median line of last week, and then you switch, for instance, to the 30-minute time frame, looking for trading setup in the vicinity of that pink line that I've drawn on the weekly chart. So you know that that's the closing price of last week. Okay, you see that? All right, it makes sense. All right, so this is about how to avoid the 78.6% Fibonacci retracement trading mistakes like a pro. So first thing first, all right, Because of all the wrong teachings that were received in the past, meaning that price at a 78.6% level, it is oversold, you should buy. Okay, that's a wrong teaching. Right? Do the verification, fundamental analysis, or dig into it before you jump and buy and hold. Yes, the stock is oversold, or the financial instrument, the security is oversold, if, okay, it is a good, it's a value for money. So which means, well, it's just a harvest time. The business is still good, they're still making money, but it's just that people are not very enthusiastic to buy the stock. Or people are investors are leaving that sector now. They are afraid about that sector and they are going away from that sector. But that company, nothing wrong with them. They're just suffering because of the general market sentiment. Or just because they are not doing well. Okay, maybe they are not doing well. That's why they came to that point. So it's wrong to just buy at 78.6%. Okay? Or the second thing that you want to check, all right, you have to check, all right, apart from the fundamental, you want to check technical reason or the time when you want to buy, all right. So sometimes, okay, it's good value for money, but you are buying at the wrong time. Market is still bearish, but the price at the 78.6% level, everybody want to sell, and you want to buy during that time. You have a deep pocket, so the time that you are buying is very important, all right? You are a technical trader, like I show you now. You see a clear-cut indication that it's a high probability turning set out. You don't want to just say, definitely it's going to go up because George says so, all right? That would be crazy, all right? You want to check the fundamental from Google Assistant, go to Google Finance, Yahoo Finance, okay? As I said before, every verification done, okay. And then you want to buy it at the right time, at the right place, using a different time frame trading method. You can use, a technical trader can use the pitchfork tool like this to determine a portfolio path, okay, for a double bottom chart pattern like this. Another thing that quite exciting, we can use, you see this session here, you want me to talk about it, because we have this smaller double bottom chart pattern, you see how the price went up, 1, 2, 3. We can use that pattern as a predictive fractal pattern because there was this smaller double bottom chart pattern and the price went up 1, 2, 3. So we can forecast using the predictive fractal pattern that the price will go up or something like that, like it did here. And then we will pull back something like this, okay? And then it will go up to that level and it will try to come down, but it may succeed to going up this time. We will see. But that's the first forecast that we can make because of this pattern here. All right? So likely that you go up like this. All right? Does it mean that the price will do exactly that? No. We are using the predictive fractal pattern to forecast what is likely to take place. But what we are forecasting doesn't mean that that's exactly what's going to happen. But if it is happening, we will take advantage of it. But we don't want to ignore the information that we have here. We want to acknowledge that information and use it, okay, to help us have a bit of idea what is likely to take place. But if something else is happening, we need that right now. It's going down. You say, George, you say to me that definitely this is a high probability to set down. Why a high probability to set down is going down? A high probability to set down has a 20% of chance to go down. So it can still go down, okay, if the price, if for many reasons, all right? So this will conclude our discussion today about how to avoid 78.6% Fibonacci retracement, trading mistakes like a pro. If you have any question or suggestion, please put in the comment section. I always read the comment, and of course I will be recording another video to answer your specific question. Alright, if this video has been useful to you, please give us the thumbs up. If you think that, George, this is a waste of my time again, please mark it down. We think this is an essential tutorial that can help other traders. Feel free to share it on Google+, on Twitter, and also on Facebook or Tumblr. If you have not yet subscribed to our channel, please subscribe to our channel. It is free, alright? click on the notification bell, so anytime we record a new video, you will be the first person to be notified. Until the next time, enjoy yourself and be very happy. We are HESGW24 traders talking about how to avoid 78.6% Fibonacci retracement, trading mistakes like a pro. Happy trading to you all, and I will speak to you soon. Thank you for watching.